Principles of Managerial Accounting, Chapter 16. In this chapter, we will talk about financial analysis.
One of the main reasons we do financial statement analysis is to compare companies within the same industry, even when those companies are not the same size. To make those comparisons meaningful, we convert dollar amounts into percentages. This allows us to see trends, like whether a company's costs are increasing as a percentage of its revenue. We also use ratio analysis, and an important reason for using ratios rather than raw dollar values is that ratios make comparisons fairer. A large company and a small company will naturally have very different dollar amounts, but ratios put them on the same scale, which allows us to compare performance more accurately. Overall, there are three major types of financial statement analysis. Horizontal analysis examines dollar and percentage changes over time. Vertical analysis, creating common size statements by expressing each item as a percentage of a key total. Ratio analysis, which uses ratios to evaluate performance areas such as liquidity, profitability, and solvency. Horizontal analysis, also called dollar and percentage changes on financial statements, helps us identify trends from year to year. It shows us what is increasing or decreasing for a company as we move from one year to the next. Most companies provide multiple years of financial statements, which means we can look at 5, 10, or even more years of data to spot long term patterns in their performance. In this example, we're looking at a balance sheet with 2 years of information, and we're examining the differences between last year and this year to see how the company has changed over time. Now, let's take a look at this example. We have the balance sheet for 2 periods. Pause the video and try to find the difference and the percentage of change yourself. When we do these calculations, we start by taking the current year figure minus the base year figure. That gives us the dollar change. To convert that into a percentage change, we take that dollar change and divide it by the base year figure and then multiply by 100%. So the process is first find the difference, then divide by the base year, and finally multiply by 100 to turn it into a percentage. So now we can see, after applying the horizontal analysis to this balance sheet, but it's just the asset section in this example. That cash decreased from last year to this year. In fact, it decreased by 48.9%. To get that number, we take this year's amount minus last year's amount to find the dollar change. Then we divide that change by last year's amount. And finally, we multiply by 100 to convert it into a percentage. We can also apply horizontal analysis to the income statement. This lets us see how items like sales and expenses change from one year to the next, whether they increased or decreased, and by how much. In this example, we can see that sales increased by 8%, but our cost of goods sold increased by 14%. Because costs grew faster than sales, our gross margin decreased. We also use trend percentages in horizontal analysis. A trend percentage shows how much a number has changed compared to a base year. To calculate it, we take the current year amount, divide it by the base year amount, and then multiply by 100%. Think of it like this. We choose the oldest year as our starting point, and we call that year 100%. Then we see how all the other years compare to that starting point. So if we're looking at financial statements from 2005 to 2020, 2005 is the base year, and we measure every other year as a percentage of 2005. In this example, you can see the income statement numbers shown as trend percentages. We also use trend percentages in horizontal analysis. A trend percentage shows how much a number has changed compared to a base year. To calculate it, we take the current year amount, divide it by the base year amount, and then multiply by 100%. Think of it like this. We choose the oldest year as our starting point, and we call that year 100%. Then we see how all the other years compare to that starting point. So if we're looking at financial statements from 2005 to 2020, 2005 is the base year, and we measure every other year as a percentage of 2005. In this example, you can see the income statement numbers shown as trend percentages. We can also take our trend percentages and graph them to see how the numbers are changing over time. When we look at the graph, we can see that cost of goods sold has been increasing faster than sales from years 3 to 5. Because costs are rising at a higher rate than sales, our gross margin isn't increasing as much as we might expect. In other words, the company is keeping less profit from each dollar of sales because the cost of producing those sales is getting higher. Now we move on to our next topic, vertical analysis. Vertical analysis is useful because it lets us compare financial statements more easily, even when companies are very different in size. In vertical analysis, we turn every item on a statement into a percentage of one key total on that same statement. This makes it much easier to see the structure of a company, how much of its assets are in cash, or what percentage of its sales goes to cost of goods sold, and so on. So, the reason we use vertical analysis is that percentages make it easier to compare companies and spot patterns without worrying about the actual dollar size of each company. So, in this example, you can see we have 2 years of income statement information, and we've turned both years into common size financial statements. Remember, a common size statement is what we get when we take all the dollar amounts out and show everything as a percentage instead. Here, for example, net income this year is 3.4% of sales, while last year it was 4.7% of sales. So even without looking at the dollar amounts, we can immediately see that the company's profit margin has gone down, likely because their costs have gone up. When we use these vertical common size percentages along with the horizontal trend percentages we looked at earlier, what we're really trying to do is understand the story of this organization. And just as importantly, we want to be able to compare this company to others in the same industry. So we start asking questions like, is this pattern happening across other companies too? Are all businesses seeing higher cost of goods sold? Or is this something unique to this company that might signal a possible problem? These kinds of questions are exactly what financial analysts and even banks look at when they're deciding whether a company is a good investment or whether there might be cause for concern. The next method is ratio analysis. These are the more common ratios we've talked about, like return on assets, asset turnover, and gross profit margin. Ratio analysis helps us take all the financial statement information and turn it into quick, easy to interpret measures of how the company is performing. So here we have an income statement for 2 years, and we also have a complete balance sheet for this organization. This is the same information that's shown in the textbook. When we start doing ratio analysis, each ratio gives us different insights about the company. Some ratios tell us about profitability, some tell us about how efficiently the company uses its assets, and others tell us about liquidity or financial strength. We're going to start with liquidity. Liquidity ratios include working capital, the current ratio, and the acid test or quick ratio. Liquidity tells us about a company's cash flow situation and its ability to pay its debts quickly. In other words, it answers the question, how liquid is the company? How easily can it turn assets into cash to cover short-term obligations? Working capital is the amount of current assets a company has left over after paying its current liabilities. So the formula is simply working capital equals current assets minus current liabilities. This number gives us a sense of how much short term flexibility the company has. Most working capital is financed with long term debt and equity, and companies have to decide which type of financing is more beneficial for them. There are financial guidelines, like the debt to equity ratio, that help determine what an appropriate balance should be, and you'll learn those formulas in more detail when you take business finance. Next, we look at the current ratio, which measures a company's ability to pay its short term debts using its current assets. The current ratio tells us how well a company can pay its short term debts using its current assets. If the current ratio goes down from year to year, that can be a warning sign that the company may be having financial difficulties. However, sometimes the change is simply caused by how the company values its inventory. That's why when you look at ratios, it's also important to check what type of inventory method a company is using, LIFO, FIFO, or weighted average. Companies using different methods can look very different on paper, even if their actual operations are similar. So comparing a LIFO company to a FIFO company can sometimes be misleading. The formula for the current ratio is current ratio equals current assets divided by current liabilities. And of course, we want this number to be greater than 1 because that means the company has more current assets than current liabilities, which puts it in a safer financial position. The next ratio we look at is the acid test ratio or the quick ratio. This ratio is similar to the current ratio, but it takes out inventory from the calculation. We do this because inventory isn't always easy to turn into cash quickly. Instead, the quick ratio focuses on quick assets, things we can convert to cash fast. These include cash, short term securities, accounts receivable, and short term notes receivable. So the quick ratio tells us how well a company can pay its short-term debts without having to rely on selling inventory. The formula is quick assets divided by current liabilities. Just like with the current ratio, we want this number to be above 1 and we don't want to see it declining over time. Now we can move on to the next group of ratios, which are the asset management ratios.